If you're a founder looking to raise funds for your startup company, you need to stop and make sure you have a funding strategy first. Most founders rush into fundraising without a fundraising strategy, which usually means you'll waste a lot of time and effort soliciting investors who you can't convince to invest. This video is a portion of our most popular training class, How to Build a Startup Funding Strategy. The full deep dive 4-hour class is available on our website, fundablestartups.com. You can also click the link in the upper right-hand corner to watch key funding strategy concepts delivered in a series of 5-minute YouTube videos. Let's dive into the webinar replay now. My name is Sam Wong. This class is How to Build a Funding Strategy that Maximizes Your Startup Value. So our agenda for today, we are just going to talk a little bit about webinar logistics. This session is being recorded. Please do enter your questions if you have any into the chat window. We would love to get your feedback as well. If something was confusing or if something really resonated with you, helped you, that'll encourage us to make sure we continue to produce similar content or to improve the content if that's what needs to happen. Okay, we're going to start this session with an overview of the funding strategy in general. Then we'll talk about a funding approach. After that, we will talk about funding vehicles. You'll notice that there are a couple of topics here that are stricken from the agenda because this is a session, this is a small piece of a large deep dive 4-hour class. We'll summarize at the end with discussion and pointer to some resources. We'll also talk about some of our training offers because this, like I said, this is a small piece of an entire training curriculum that we spent years building out. Okay. This class, the full class does include downloadable tools, but we're going to skip some of that content here. To give you a little bit of background, my name is Sam Wong. I am the CEO of Fundable Startups. I have been the CEO, CTO, or a technical VP for 5 different startups. I've also advised multiple startups. So the first 2 startups on this list were very promising, but unfortunately they shut down. And looking back in hindsight, they shut down for very avoidable reasons. Thankfully, the last 4 companies on this list were acquired. Today, I typically serve as a CEO coach or a fractional CTO, CEO, CFO, whatever is needed. Okay. I also wrote a book on startup execution. I develop and teach startup training classes, which you can find on our fundablestartups.com website. Our focus, as I mentioned, is to build fundable startups through online training on deep dive startup topics that are packaged with digital tools that helps you to take actionable value. The full version of this class is 4 hours long, okay? And it's very challenging because there's a lot to really do. I believe in not just skimming the surface because details matter. And as we get into some of the content, you'll see why, okay? We do have a couple of polls during this session. It helps us to understand you better. Derek, if you could pop up the first poll. We do offer primarily startup training, but also startup coaching. And that's one of the things that I know I needed the most when I was a first-time CEO was it was helpful to have concepts, but it's much, much more helpful to be able to have someone helping me see things. It's one thing to read something from a book. It's another thing to have someone actually train you. It's one thing to watch something on TV. It's another thing to actually do it. So if it was easy to do, when I watch the Olympics on TV, if that's all it took, I'd probably have multiple gold medals now. I don't. Okay, I need a lot of people to help me implement what I see and learn. And that's what we're trying to do coaching, just trying to understand what your perspectives are on group coaching. Okay. I mentioned earlier, this will be a lot of information. We are going to go fast. My general philosophy is your time as a founder, as a startup entrepreneur is valuable. I try to move quickly. I want to, skip a lot of fluff. We talk about stuff that really, that I wish I knew when I'm trying to solve these exact same problems. Okay. We do have a disclaimer, unfortunately. This session does not constitute legal, tax, or financial advice. So we do encourage you to consult a qualified professional who knows your situation. Okay. So to start with, we are going to talk about what is a funding strategy and why it's important. Okay. So what I found is that most founders have a very simple set of priorities. Probably over 90% of them focus on pitching, then pitching again, and pitching some more. Okay. When I go to startup events, and when they were actually happening in person, the honest truth was when people find out that I'm a startup advisor, a startup coach, they almost always ask me, 90% of the time, they ask me some type of question related to pitching. Happy to answer them, but the reality is it's a bit of a problem because focusing on pitch tactics, which is what most of these questions end up focusing on, without doing a funding strategy is a mistake. What we found is that most startup founders have a follow the herd mentality towards fundraising, which means they basically try to figure out, where am I at today? How does that compare to where other people are at? And for other people, what have they done? So you can do some research that says, oh, I think I'm trying to raise seed funds, and you can get a graph like the one here on the chart and say, well, this is what the valuation or whatever it is. But what ends up happening is if all you do is follow the herd, you end up getting something that doesn't fit you very well. Okay. And it tends to be a rather haphazard, unplanned, non-strategic process that makes it really hard for you to hit the target that you need to hit. I believe in taking a strategy to anything that's important, including fundraising, which is one of the most important things you as a startup founder will do. So when you take a strategic approach, you have a much better likelihood of actually hitting the target that you need. Okay. What we found is that when you don't do a strategy, when you don't do the bottoms up planning, a lot of people make some common mistakes. One of the common mistakes is not raising enough money. Okay. Obviously, if you don't raise enough money, you'll run out of cash before you reach your next goal, which means when you're running low on cash, you have to raise money in desperation. So when you raise money in desperation, that usually means you have to get a bridge loan. And in the US, there are a lot of companies that will give you a loan against your paycheck. Those loans come with horrible rates. Bridge loans are oftentimes similar to that in the startup world. Okay. I've seen founders also raise too much money. Some people say you can't do that. There's no way to be able to do that. It's always good to have more money than less. And yes, there's some truth to that. But the problem with raising too much money is what that means is that you have raised more money than you needed at a lower valuation than was appropriate. Okay. So what happens when you raise more money than you needed at that time is you end up selling too much of the company to the investors. You over dilute yourself unnecessarily. When you over dilute yourself, you are also more likely to lose control of your startup faster. Another problem that comes up is people do not understand the importance of terms. They take money from a seasoned investor before they have optimal leverage, and then the investor dictates the terms of that fundraise. You may be saddled with very, very restrictive controls. I had one founder who was desperate, did not do a funding strategy, did not make himself fundable, and he could not spend more than $10,000 without getting board approval first. Every time you did, it's really easy to spend $10,000 on anything substantive. So he constantly had to go back, convene a board meeting, and get an approval. It just was a bear to be able to run the company. Okay. You can also raise money from the wrong investors. Okay. There are investors who are fantastic at what they do. They know how to roll with a company when it's going through turbulent times. And there are investors who don't know how to do that. So when you take money from the wrong investors, what usually happens is that you're having to maintain and babysit them a lot more than you would have to if you took money from a seasoned professional investor who really knows how to help you. The outcomes of these 4 mistakes is you'll usually have a smaller upside, you'll probably lose control of your company faster, and you'll have painful operational problems. And the sad thing is, most of these problems are not visible until 1, 3, or 5 years in the future. The right way to fundraise is to build a defensible, bottoms-up set of detail to understand when, why, and how much you need to raise and from where, and then align that with how your startup is going to be built. These are the elements that feed your funding strategy. Okay, it can be very hard, grinding work to be able to do it, but it doesn't have to be if you have some templates and someone who can guide you along the way. The components of a funding strategy are fourfold, okay? The first two are the approach and the sources of your funding strategy. Then you have to consider the vehicles and the targets, okay? The approach really, these four elements answer several questions. The approach answers the question of when should you raise money? Why should you raise money at those times? And how much should you raise when you're raising? Sources is all about from where, whether it be high net worth individuals, angels, semi-professional or professional investors or institutions. Vehicles is what type of contract that you will use to raise the money. You shouldn't just take money, everybody who knows what they're doing will ask you to sign a contract. Targets would be, okay, of the types of sources that you're going after, exactly who. Not every VC is the best fit for you. If you are a biotech firm and you're trying to raise money from someone who never invests in biotech, they don't understand the longer timelines that it takes to develop a product to get through FDA approval, and that'll probably going to cause you some pain. So you have to understand who to target as well. When you figure out and determine all four elements of these, then you can go forward and confidently execute on that strategy to do a proper fundraise that's sized for you. The most important element of those four categories is the funding approach. The other three are very important, but we're going to spend the bulk of the time on funding approach because most people tend to not do this the right way. The reality is here, we have a chart that shows a company's growth in value over time. It's usually not a smooth curve. What usually happens is that the company hits certain inflection points that dramatically increases its value. Those inflection points should be objective and hopefully, if at all possible, quantifiable and not just qualitative. When you hit those inflection points that are indicated here on the red diamonds, what happens is that your company will dramatically increase its value and how much you can ask as a valuation with a potential investor. So you want to raise money immediately after you hit an inflection point, okay? The reason you do that is raising money at the peak of your company's value increases your leverage as a founder to seek optimal, not just valuation, but also terms. So if the most important time to raise money is the little green area after an inflection point, that means the worst time is the red area right before an inflection point. If you do not know where your inflection points are, then you have a chance of, maybe if you're lucky, you'll raise money right after the green or right during the green. But if you're unlucky, you might raise money during the red, and that's not going to be as good of an outcome for you. We also talk about terms, and we want to get into this a little bit more detail. You should not ignore them. I'll give you an example here of a company called Fanduel. Is a sports betting company that got acquired back in 2018 for $465 million. If I had an acquisition like that and I had a decent amount of equity, I'd be quite happy. You'd think so. You think that the founders would be dreaming of the luxurious life. But what ended up happening was that the founders and most of the employees got zero out of the acquisition. Okay, how in the world does that happen? Well, it turns out that some of the terms from earlier stages of investment basically gave certain investors the ability to force certain decisions on the rest of the company. So the company had certain investors had drag along rights to be able to pull the company in a certain direction. They also had something called a very high liquidation preference. Okay, so what is liquidation preference? Liquidation preference is one of the terms that will regularly show up in an investment contract from a professional investor. And what that means is that if the investor has liquidation preference rights, they will get head of line privileges to eat first from any proceeds of any acquisition. They get VIP treatment. Everybody else has to wait in line. So there are two elements of liquidation preference. There is a preference multiple. It's usually 1, 2, or 3x. And there's also participation rights, which can be none, capped, or full. The green choices here are more preferable to the founder. The red means not so good for you, okay, if you're a founder. So if you take these two elements of liquidation preference and plot them on a two-dimensional chart here, you get a 3x3 matrix. And basically in the lower left-hand corner, That's what you can ask for in terms of liquidation preference terms if you are a healthy company. If you're not that healthy and not very fundable, then the investor has leverage and he will ask for liquidation preferences more in the upper right corner. Okay, so suffice it to say is that the Fanduel founders had taken an investment with and given away drag along rights, and liquidation preference is common, but they gave away too much on the liquidation preference rights. What ended up happening is that when the acquisition came in, the investors sent this letter. This is the exact letter that went to the founder, the founder legal counsel. And they basically said down at the bottom, drag along rights are being exercised by us, which meant the way that the deal was structured and how much was the company was being acquired for, the employees were getting nothing. Okay, so you think, gosh, if you're a founder, I'm not going to sit still and watch my company be sold and years and years of my blood, sweat, and tears. I'm not going to watch that just be taken away from me. So what did the Fanduel founders do? Well, in 2018, May, the merger was announced. In 28, a couple months later, 2 months later, the founders filed a lawsuit to block the merger because they're like, they could do the math. They saw what was going to happen. They're not going to get anything. Well, a couple days later, the merger closed anyway. The lawsuit didn't stop it. There are certain news articles that say basically the lawsuit went nowhere. And in about a little over a year later, the lawsuit was dropped, suggesting that basically the founders didn't really have a very good case. The founders were actually ordered to pay the defendant's legal fees. So they sued someone. The other party defended themselves and probably racked up tens of thousands, $100,000 maybe. The founders had to pay the legal fees. Okay. What this says, the founders did not have a strong case because they signed contracts with investor-friendly terms. This was nothing to do with the founder attorneys during the acquisition. It's not like those attorneys were incompetent. The attorneys said, you signed these rights and these investors have these rights, so there's nothing you can do, unfortunately. What this basically means is that terms matter. Okay, do not ignore them. Most founders rush into fundraising and they start doing backflips and say, oh, I raised $1 million, I raised 2 million, I raised whatever amount of money. But okay, great. These terms did not come back to bite the Fanduel founders until years later. And this happens often. Fanduel is an extreme case because the founders did get nothing, but there are many, many cases where founders got a lot less than what they anticipated. Okay, so I'm going to stop on that issue about terms for a second and keep moving on. Okay, how much should you raise when is part of your funding strategy? Well, the fundamental answer is you want to raise enough money to get past the next funding milestone, your next funding inflection point. Okay, so we've talked a bit about some stuff. As we go into a question break, Derek, if you could pop up the other poll, just would love to know how much has been invested in your startup. Okay, either by yourself, by third parties, etc. The total amount of what's been invested in your startup. Okay, see, and we're going to pause for a quick question break. Derek, any questions we want to be able to touch upon before we move on?
Not currently.
Okay, great. So do use the chat window if you do have any, and we're going to keep going because we got a lot more content. Okay. We want to spend a brief moment talking about funding vehicles because they are fundamental to the fundraising process. We've got a lot of content on funding vehicles, but we're going to move fairly quickly through it. First, some basics. I figure that a lot of people already know this, but there may be some people who would like a visual view of this. And this is just details about startup valuation and investor ownership. Okay, so how a startup raises big money, at least from the investors, is typically they sell stock to the investors. So you have an investor says, hey, I'll give you $2 million cash, you give me preferred stock, and we're all happy. So before the basically before the investment, the founders and the employees own 100% of the company. Okay, after the $2 million funding event, the investors now own a part. The pre-money valuation is what the company was worth before the investment, and in this case, it's $6 million. So the pre-money valuation is determined just basically through negotiations with your investor. Okay. So the best way to be able to get a high pre-money valuation and good funding terms is, once again, build a healthy, fundable startup. All right. I got to move the poll out of the way. As we continue, the post-money valuation is what the company is worth after the investment is made. So since $2 million was invested, the post-money valuation is $8 million. So pre-money valuation plus amount invested is equal to the post-money valuation. So in this example, $6 million plus $2 million invested is equal to an $8 million post-money valuation. So before the investment, the employees owned all of the company, and after the investment, the employees own 75% and the investors own 25%. So how do you get that math? It's determined by taking the amount invested divided by the post-money valuation, which equals the 25%. So 2 million divided by 8 million gives you 25%. All right. So the pre-money valuation is what the founders and incoming investors agree that the company is worth before the investment is made. And the post-money valuation is what the startup is worth after the investment closes. I'm looking at the time. We're going to move a little quicker and skip some stuff here. This is covered in the full class, but basically there's some details here about stock. There are two types of stock. There's common stock and preferred stock. And to determine how much you own in the company, you just take the number of shares outstanding divided by the number of shares that you hold, and that gives you your ownership percentage. This looks like simple math, but it's actually a lot more complicated, because determining the denominator, the number of shares outstanding, is actually non-trivial. I've got a video on it on YouTube. Fully diluted shares is the term that you want to understand, and it's a visual explanation with a Venn diagram if you're interested in understanding fully diluted shares. In fact, many startup founders don't even understand the content here. So I would encourage you to dig into that. As I mentioned, there are two types of stock, common and preferred. Preferred stock has extra privileges that makes it worth more money. Investors, professional investors, usually hold preferred stock. Common stock is usually only held by the founders and employees. Okay, the price per share for common stock, don't guess. I've seen tons of founders just say, I want to sell some stock and I think it's worth, $1 a share. You should not guess. You should not arbitrarily pick a number. The right way to be able to determine your price per share on the common stock is to do a 409A appraisal. In the US, if that's where you're located, the taxing authority here has section 409A of their tax code, and that's the area that talks about deferred compensation. And this is where the 409A appraisals come in. It's a process where an independent third party, or you could do it yourself if you know what you're doing and follow strict processes. It comes in, you come up with a process to say, we believe the startup is worth this amount of money, and that determines your common stock share price. Normally, the preferred stock has a higher per share price because it has extra privileges. The common stock has a lower per share price, and that's by design. That's what you want. You as a founder do not want to see your common stock share price artificially grow too rapidly, because that affects the potential upside of you and your employees upon an exit. The common stock share price should be the stock option strike price. I've got a whole nother set of videos that talks about that. We're going to skip that here, but just make sure that you do not have that price wrong, because there are tax problems that come up if you were to get it wrong. Okay. Tax problems or overall payout problems. As we look at funding vehicles in general, now that we understand, common stock, preferred stock, and that investors buy preferred stock, we should talk a bit about the early stage investment vehicles. Okay, so common stock and preferred stock was what we just talked about. Professional investors do not buy common stock. They only want the preferred stock. Okay, so how do you fund your company, given the fact that professional investors want the preferred stock? Well, lots of people fund it with a loan. It could be either a founder loan to the company, which is done from time to time, or maybe some people say, well, what about a bank loan? Or what about a loan from a family member? That's possible. You might be able to get a loan from a family member. You almost certainly will not get a loan from a bank if you're a true startup company, because you have no history and no ability to demonstrate your ability to pay back the loan banks loan money expecting to be paid back. So you could potentially get a loan from a private party. That private party might give you $500,000 in this case. They'll determine an interest rate and they'll say the loan is due back on paid back on a certain date. Excuse me. So how do you get an investor to loan you money? Is that going to produce a good return for the investor? And the answer is almost always no, okay? Because startups are high risk, they spend all the money, they're likely to not be able to pay back the loan, okay? So if everybody, including the professional investors, really want the preferred stock, how do you do this? How do you get a loan from an investor? And the answer is you modify the loan and build in a future conversion to convert into preferred stock. Okay, so what starts off as an ugly caterpillar turns into a butterfly upon that conversion. The yellow area that's highlighted here, that's the definition of a convertible note. It starts off as a loan, and then at some point in the future, it turns into stock. Okay, the investment amount is basically, when you do convert it, it's basically treated as if that the investment balance is treated as if it was raised when you do sell preferred stock. So the conversion, the trigger that converts the convertible note into preferred stock is when you sell preferred stock to a new investor. Okay. So there is still a problem. What if you can't find an investor to buy preferred stock to trigger the conversion of your convertible note? Well, then that means you're going to reach the maturity date of the loan. And what do you do if you can't pay it back? Well, that means your lender has the right to foreclose on the loan. What that means is that they can come in and force your company to be liquidated, all right, and to try to recoup any assets back from the cost, the value of selling your assets in the company. They can shut your company down. Well, nobody really wants that. You, of course, don't want that to happen. And a smart investor doesn't want that to happen either, because they'll almost always get pennies on their dollar, if at all, if it's even worth the trouble. So if nobody wants that, how do you fix it? The solution has been to remove the requirement to pay back the loan. So you modify this convertible note and you make it not a loan at all. And that's what the SAFE is, a simple agreement for future equity. It's very much similar to a convertible note. It's just not a loan. There's no interest rate and there's no maturity date. It was created by Y Combinator, and it was an interesting invention. It's basically, it will convert to preferred stock the same way a convertible note will upon future financing. There are some challenges with a SAFE. We won't get into them here. Okay. Today, the most common ways to be able to invest in a startup will be a convertible note, a SAFE, or preferred stock. As I mentioned, there are some challenges, but we have another class that dives deep in it. It's an hour long. It's our founder's guide to safe startup fundraising. Okay, it's an hour long detail, and the reality is most founders and many startup attorneys don't even know what they're doing with SAFEs. I've had probably 15, 20 attorneys attend my SAFE webinar, which is a free class, and they're like, oh, okay. They didn't know how the math works out with that detail. There are two types of SAFEs. There's a post-money SAFE, pre-money SAFE. The post-money SAFE, in a nutshell, increases founder dilution. Learn all about that in the SAFE startup fundraising class. So looking at the time, I'm going to skip past some of this here. It's nice to be able to know how these convertible instruments convert into stock so that you understand the math. And it's important because if you don't understand the conversion process, what will usually happen is that you have no idea whether when the Series A preferred stock sale comes in, how much that convertible instrument is going to convert to. Okay, so this is not just a simple exercise of, oh, interesting. No, this is something you actually need to know so that you can predict how much of your company has been sold. Okay, there have been many cases where founders signed a lot of SAFEs and convertible notes, and then when they finally sold preferred stock, they did not realize that, oh my God, my convertible instruments added another 20% dilution. They never did the math because they never understood the conversion process, and that basically hurt them. It took money out of their pocket. Okay. We're not going to get into the detail here. I've got another video on YouTube about this, and we also have it in the full class. Okay. Suffice it to say is that, there's some mechanics that we walk through that shows how to be able to do the math depending on the valuation cap, the discount, etc. There's 3 different scenarios that could come up, whether you have a low, a mid-range, or a high valuation. Okay. Well, the video walks through how the math works. Okay. But suffice it to say is at the end of the day, the 3 scenarios, low, mid, and high range, there are different amounts of equity. And if you look at the pie charts, you'll notice that the green is what the employees get to keep. Depending on the 3 scenarios, that green slice of pie is somewhat small on the pink and much larger on the green on the scenario number 3 on the far right. Okay. So it's something you want to be able to understand. It's something you also want to model, and that we should talk about how to model your future dilution in the SAFE class that I mentioned earlier. Okay, so let's look at how this compares to, actually, no, I'm going to skip this. Sorry. Let me jump ahead to a fundraising example for the sake of time. Okay, so what does this all mean? We've talked about the funding strategy that you want to raise after you reach an inflection point. How does that affect you as a founder, and how much equity that you own, and what your payout will be? Well, let's look at comparing 2 specific scenarios. You will have a company that does this, the growth path on that you see, the stair step up growth. Okay. On the left side, the company builds a funding strategy, and they know very well how much money they need and when they need it. So the first round of fundraising, they just bootstrap themselves. Then the second round, they raise 200,000 through a pre-seed in a post-money safe. And then the third round, they do a seed fundraise for $2 million. And for the sake of illustration, let's say they get an acquisition offer very early. Okay, $40 million, they get acquired. They say, hey, take the money and run. They're happy with it. Okay, so that's the math on how much they get paid out. But if you don't have a funding strategy, you're liable to do it wrong. The second scenario on the far right has the exact same company with the exact same growth path. The first thing that they do, they have a good idea, so they get someone who's interested, and that interested party gives them a $150,000 convertible note. It gets them past the first inflection point, but it's not enough to get to the second inflection point. So they have to get a bridge round, okay, some bridge financing. And bridge financing does not come with great terms. Then when they finally do secure the seed round, they get a $4 million round. Yeah, it's nice and healthy in terms of size, but it's also not the best terms. And if you were to break down the bullet points in those pink boxes, none of those bullet points are outrageous. It's not like we made them the worst possible for the founders. No, they're reasonable. They're all middle of the road, or terms that are appropriate for where that company might be. They're not great, but they're not horrible. Okay, even with mildly investor friendly terms, how does this work out? With the same $40 million exit, what happens is that with the funding strategy, the situation on the left, the employees get to keep 31 of the $40 million acquisition price. But without the funding strategy and not having smart, intelligent fundraising, the employees only get to keep 8.8 million, which is a 3.5 time difference in the payout. Okay, this is a very real scenario. There's lots of other situations that that people have written about how this can definitely come about. Okay, so we're going to spend a little bit of time here talking about inflection points. We said inflection points are important, but what are they? Okay, well, if you want to align your inflection points, your funding approach with the inflection points, you need to understand the 4 types of inflection points, and they are product, sales and marketing, business development, and intellectual property. Each category of inflection points, you'll have subcategories. Okay, so you'll have specific metrics that you'll have to determine and customize for your particular startup. Okay, I've got some examples of how some other companies, some general categories of what types of sub inflection points, low-level inflection points are possible. Okay. But basically, once you determine your low-level inflection points, you use those to drive the funding approach. And you take your funding inflection points to turn them into funding milestones. Okay, your product, sales and marketing, biz dev, and intellectual property inflection points into funding milestones. So visually, if we have time going to the right, you look at your product team. Maybe you talk to the CTO or the VP of product or whoever that guy is, and that person says, this is how we want to build out our product in the future. You have these 5 inflection points. Then you have to do the bottoms up to say, how much is it going to cost? Well, we got to buy these dev tools. We got to do this. We got to build up a lab. It's going to take X number of weeks, et cetera. So you determine the time and the cost for each one of those low-level inflection points. You do the same thing. Whoever's in charge of marketing, that person has to determine their inflection points. Maybe the second inflection point is we do a crowd survey or something like that. The third inflection point is we get our first 5 customers who pay us, et cetera, whatever it may be. Okay. Then you have somebody who's doing business development. If you happen to be a type of company where your partnerships matter, that you're not going to build your own sales team, you're going to sign an agreement with a distributor to help you distribute your product. Then business development, those types of agreements, if you were able to sign a prominent distributor to help distribute your product, that's worth something. That would be an inflection point that you could call out when you're trying to do your funding strategy. You could also have intellectual property inflection points like trade secrets. Most common is a patent, okay? But not every startup has patentable content. Not every startup will have significant IP inflection points. But if you do, let's assume that that's what they are. So now you've got this chart of all these inflection points. How do they convert to funding milestones? Well, you want to basically look at it, and hopefully you can coalesce certain groups of inflection points together into a funding milestone. So you say the individual bottoms up, whatever those costs of those inflection points are and whatever the time is, you add them up and then you pad it a little bit. You say, I want to raise 25,000 to start the company. Hopefully you and your founders can chip that money in, because bootstrapping is the best way. 25,000. Hopefully, if you've been working for a while, you've been able to save up some so that you can avoid some dilution by bootstrapping to start with. So that 25,000, you're running lean. Maybe it lasts you 4 months time. And hopefully, if you execute well, after that 4 months time, you've hit those 4 inflection points in the black dotted line. That gives you the opportunities to start fundraising then. And then in that next fundraise, you're going to paint out the picture of what the next steps are going to be. You'll group together the next set of funding of low-level inflection points into your next funding inflection point. And let's say you add it up, do the math, et cetera. You want to raise 120,000 in a friends and family round, okay? And that 120,000, you'll know because you've done the bottoms-up financial model, that's going to get you a little bit more than a half a year. You're still running very, very lean, okay? You're not wasting money. It gets you a little bit more than a half a year. That half year is more than enough to hit the next funding inflection point, which at that point, you can raise your pre-seed round of $750,000 or your seed round of $750,000, which you think it's going to take you, a little bit more than a half year to get you ready to raise your Series A. So hopefully that illustrates how you would work this, and the class that the full class has other tools to be able to help you identify your inflection points. We've got this low-level inflection point worksheet. We've got some other content that helps you roll them all up into your high-level funding inflection points, including stuff like a Gantt chart for your project, as well as for your products, as well as your funding milestones. Okay, so we're gonna skip all that stuff here for the sake of time. Okay, I do apologize. I'm gonna pause here and because I gotta skip to the end here. There's basically a ton of content. I apologize for going a little manual here. All right, this is the set of slides that is in the full class, and I'm going to jump to the end where we have, okay, I'm going to jump to the end. As you can see, there's like 200 plus almost 300 slides here that goes through the detail of how to build a funding strategy. Okay, let me go here and we will go into full screen. Okay, everybody can still see the slide? Yeah. Okay, great. So to summarize, I want to leave some time for questions and also talk about our training. The funding strategy, funding approach, sources, vehicles, and targets. We spent most of our time talking about approach. There's a whole ton of other stuff talking about that we still could go into. We go into a decent amount of detail because it's not just a good idea. Most people need help to be able to build this stuff out. Having done 5 startups and having gone through the pain, I can say with personal experience, I've got the scars to demonstrate it. Startups aren't easy. Okay, it's very unpredictable and there's some peril involved. The best way to handle that is don't just start, going down a path that is perilous. Spend a little time to build a funding strategy, just like paving the road in advance, because that will make the journey faster and easier. Sure, it takes some time to build it, but it's worth it, especially if you're taking your family along with you. The reality is you may be the founder, but if you have a family, they go with you. What affects you affects your family. So it's important. I'm not going to take my kids, driving through an unpaved jungle road deep in the Amazon. Okay. Yeah. All right. So any quick questions, Derek?
We had a couple from way back, okay. But we had Andrew ask, is it advisable to consult with legal counsel before taking on funding?
It's always good to get legal counsel. It's always good to get advice. I believe in that heartily. Okay. The challenge is most startups don't have a large legal budget and lawyers cost a lot of money. Okay. We've got an approach to be able to help you with that. In fact, we can dive forward. If you'll wait another 5 to 7 minutes, we'll talk about how our training can kind of help you with that and help you minimize your legal costs. Okay.
We had a question again all the way back from Arthur, who asked, would you need to include in your slide decks, and do you recommend sales or investor deck?
Yeah, so I suppose the question is really about pitch decks. Okay. We are in the process of building our ultimate guide to pitch deck. The reality is there's lots of content, lots of people with lots of different opinions about what to put in a pitch and how to do it. If you look very closely, some of the guidance disagrees with each other. The one advisor says do it this way, another advisor says do it that way. Both ways could probably work. All right. We do have a pitch scorecard on our website, Fundable Startups. It's in the blog section. It talks about why we use a scorecard. And in the scorecard, there are 11 different categories that we summarize. We've got another blog that we're working on where we're trying to do a high-level survey of many types of advice where if one person says do X, another person says do Y, we're trying to combine them to let you know. That blog is not yet done. The reality is we spend so much time on marketing that I prefer to build content. I'll be honest, I'm not a marketer, okay? I prefer to build content, but in order to get the word out there and to fund what we do, we sell the training classes, we do the coaching, etc. So long story short, there are lots of things to be able to put in. We have a set of YouTube videos where we've participated in a regular pitch event called Pitch Force. So we've got 4 YouTube videos so far. We've got 15 more coming where you can watch someone else pitch. And then we take little snippets, real founders. These are real founders pitching their startups. You can watch someone else pitch. And we take snippets of the Q&A and then the feedback at the end about what they would have helped to improve their pitch. And then all the way at the very end, I have a 3 to 5 minute summary of why I gave that feedback. Okay. So it's one thing, like I said, to read some suggestions on what to include in your pitch. I think it's another thing to actually get coaching on it. You don't learn how to ride a bike from reading a book. Okay. It can help, all right, learn concepts, but it really takes some practice. Practice with someone who can give you good coaching to be able to refine it. We do have group coaching sessions. Recently, because of the flow, we had to restrict our group coaching sessions to just people who have purchased our training. Okay. And we'll talk about our training in a few slides. Okay. Let's see, it's 9:45. I'm going to keep going here and continue. All right. There's a couple of other thoughts that I wanted to share before kind of talking about what we do in more detail. The first and most important, I'd say, besides just doing the funding strategy, is make sure you build a healthy startup before you try to fundraise. Okay. I've seen tons of people focus and just rush into the fundraising process, and they usually suffer for it. Build a fundable company first, okay? Because people have said that pitching is like trying to get a date. In fact, they've said, when you get an investor, that's like getting married to them, okay? Sure, there's some truth to that. Who would you rather date? Okay. Who do you think is a more preferable date? I should say the person on the left or the person on the right. You don't want to be a Frankenstein of a company. Okay. Because that's not really fundable. A fundable company raises money faster, has an easier time do it. It's not as hard of a problem. They tend to have higher valuations and they get better terms. Remember that Fanduel example. If you're not very fundable, even if you do raise money, it's going to take a lot longer. It's going to be a lot more painful process. It's probably going to come with a lower valuation, and it's come on bad terms. In fact, I found this quote from a question on Quora from a startup founder. This founder says he, she, whoever it is, spent 10,000 hours working on the startup, but still can't raise money. Okay. I'm like 10,000 hours. That's 5 years full time. This guy is definitely doing something wrong. If working for 5 years full time and you still can't raise money, they're not fundable. Okay. That's why you've probably heard this term, practice makes perfect. Actually, Vince Lombardi, former coach of the NFL champions or football champion Green Bay Packers a long time ago, he actually said, no, practice doesn't make perfect. Perfect practice makes perfect. I've seen tons of founders. I'm practicing. I'm working hard. You're practicing the wrong way. Okay. So it just pains me to see people do it the wrong way. So that's what we're trying to do. That's why we go into so much more detail with our training. We've got 24, 25 hours of training built so far. And it's not just 3 bullet points on a slide. Our training includes templates, okay? Because there are many things that you as a founder will probably do for the very first time, okay? If you're baking a cake for the first time and not really comfortable in the kitchen, like my daughter at age 10, she was able to do it with a cake mix, okay? Simple recipe, simple ingredients, fewer tools, not quite as much expertise. If you had to do it all from scratch, complex recipe, a lot more ingredients, a lot more specialized tools, probably make a bigger mess, and you probably need some better skill to do it the right way, all right? It's just harder, all right? So that's why we include a lot of ready to use, colored by numbers tools and templates in our startup training, okay? So there's a lot of startup training available. You can get it tons of places, just Google search. Why did we create our own? Well, number one is that when I looked at when I was running my startups myself, there's a lot of stuff out there, but it wasn't structured. Okay, there was no journey. It was a mass of disorganized concepts. And that's why we created what you see here, the little snippets, those graphics. That's a startup roadmap. It's a high-level infographic paired with a low-level reference chart that shows your path to fundability, because random information is just disorganized. It's almost like, how do you get 50 people in an orchestra to play a symphony if they're not playing the same sheet of music? If you don't have a conductor, you just get this horrible set of noise. Okay, they may be all skilled at playing their instrument, but it's not going to sound good. Okay, so the second reason is that I saw a lot of content from, I'm not sure, people who really knew how to build a successful startup company. Okay, so I already mentioned that my background, 5 startups. I served as advisor for a number of accelerators. And then I also came with a management consulting background with big corporate IT experience as well. Okay, I've done both technical and business roles. Okay, 4 of my roles were technical. I had to transition to business. I crossed over, but I still enjoy doing the technical stuff. So basically, of the 5 startups, I had 3 acquisitions, and then also one of the companies I advised got acquired as well. But honestly, I learned more from the companies that shut down, that failed. Okay, they say you learn more from your mistakes than you do your successes, and I think there's a lot of truth in that. So I worry sometimes when I see what a one-hit wonder, somebody who captured lightning in a bottle one time. Sure, they may have had a big exit, but that doesn't necessarily make them a master company builder. And there are many cases where people who had one successful exit ended up failing on their second or their third venture. Okay. The other reason that we wanted to build our own content was deep dive. There's lots of people who give 20-minute details on funding and how to do it. I have hours of content on do it because it's such a complex problem. Okay, we want to go deep. I do not believe that's actually a screenshot from another person's business advice website. 1-minute business tips. Okay, they may be good in concept, they may be informative, but they're not going to transform anything that you do, quite likely. Okay. The other thing is I try to build very visual content. I realize that training, online is tough, but studies have shown that when you have visual aids, it increases retention by 400%. We do not believe in slides that read like the dictionary or that yellow slide down at the bottom. That's a rendition of an actual slide from another accelerator. Okay, build stuff that people want and reach and serve all those people. Of course, that's what we all try to do, but how do you do that? It's not that easy. You can't just say it, snap your fingers, and it's done. The fifth reason is that we have ready-to-use templates and tools that I'm a developer, so I tried to build them with reuse in mind. These were not tools that I harvested from old projects. These were tools that were purpose-built to help you, so they actually are more usable, I'd like to think, at least. Many other training classes do not have that. And as an example, I said before, this is actually a snippet of a 4-hour class. If you look at the content, the topics in the full 4-hour training class, this snippet has covered maybe 15%, 1/5, 1/6 or so of the content. There's about 85% that's still not yet been covered. Okay. We have structured our training into 4 tiers. We have a basic tier, which is no cost content that you can use to sample free. Okay, we want to give back to founders who are still kind of not ready to, haven't budgeted for their startups just yet. Then we have a starter tier, which is low cost content for very early stages. A lot of the content in our starter tier tends to be for, if you're forming your company, if you just formed it, more early stage types of situations when your budgets are lower. Then we have a pro tier, which is affordable content. This helps you to build a solid foundation, avoid the big potholes. Okay. Then we have premium content, which is high value if you really want to be able to build it right and scale, etc. These 4 tiers, free for the basic. It's about the cost of 2 cups of coffee, 2 frappuccinos at Starbucks every month for the starter tier. And then pro and premium are one-time payments. We've structured our 25+ hours of training into core and expanded. Okay. If you are taking a bachelor's degree in college, I would ask that you take all the core training. Okay. If you're trying to be a startup entrepreneur, then the expanded training is the electives. You should take as many of the electives as possible, just to be able to make sure that you complete your startup education. We do have coaching, which is kind of like the office hours. And again, as you go from tier to tier, you get more value from each tier. The basic training tier includes 5 classes down at the bottom. It represents a little over 4 hours worth of training. I mentioned the Founder's Guide to Startup Fundraising, Safe Startup Fundraising. That's probably our second most popular class. All right. This class is the funding strategy at the top, and this funding strategy, a portion of it is available in the next tier up, which is the starter training tier. You get about 10% of the content, which is effectively kind of what we covered here, maybe about that amount. Then the pro tier gets you 18 classes. The starter tier got you 13 classes, and the pro tier gets you about 18 classes. You get more of the core training, and then premium gets you basically everything. Okay. So we do bundle the coaching with the training. Okay, I'm going to skip some of the details. We have group coaching, which is available on the lower cost or free tiers. Then we have one-on-one coaching available on the pro and the premium. Okay. Our goal is that you learn in the online training class and then take the coaching to be able to learn behind the wheel. Okay, that's how most people learn how to drive. We'd encourage you to try. We think that's a process that works. We've got a lot of testimonials that people who've taken and purchased our training, who've gone through it, that we're very proud of. This comment from this one founder that's basically said, that was the most efficient breakdown of a complex topic I've seen in all my fumbling around with different startup content. Okay. When you compare to an attorney, the average partner, okay, that's the guy who really knows what they're doing. The average partner will, in a Silicon Valley mid-sized law firm, will charge $600, $650 per hour. So for less than an hour and a half with that attorney, you can get the starter package or the pro package. Okay. For less than 5 hours with the attorney, you can get our premium package, and our premium package includes 6 hours of one-on-one coaching with me. Okay. So I built this because most typical law firms, they'll help you with formation details, legal strategy, term sheets, contracts, whatever. What we try to do with our training and coaching is give you so much more across a variety of topics. Really, we're an execution specialist. So it's not just about fundraising. Execution is how you build a fundable startup. We want to, with our Starter Pro and Premium packs, help you to build the foundation and then to execute well. And all the training is done. You can watch it as often as you want without having to worry about my attorney's going to charge me for every 6 minutes. Okay. So we even have startup attorneys who say, hey, this helps, because the ones who really do it right for the founders, they're not trying to run up the bill because they know the founder doesn't have a lot of money. But the challenge is most founders need to be educated. Okay. This comment from Matt Rossetti is that our videos can save his clients a ton of money, because it saves him from having to answer the basic foundational questions, and they can get that done, and then they can just really focus on legal execution with their attorney and save a lot of money in legal fees. So that's it. Basically, if nothing else, I would encourage you to sign up for the basic training tier. It's free. Go to our website. That's where we have a lot of the free training classes, and it's not lightweight training. It takes me about 100 hours to build 1 hour of training. So for 4 hours of training, that's about 400 hours of my time. All right. You can also get the downloadable resources like the infographics I mentioned earlier. This particular class, to summarize, so you get a small portion of it in the starter tier, a larger portion in the pro, you get the entire class in the premium. Go to our website, fundablestartups.com/solutions. And that's where you see what we have to offer. So that's it. Let's kind of dig through any more questions. If people can stay late, I'll stay as late as long as I can until my next meeting. Okay.
Awesome. So again, I'm going pretty far back for questions, but we had another question come from Arthur, who asked, are there any metrics that investors specifically look for in early stage deep tech startups?
Yeah. So metrics, yes, a smart investor will look at metrics. In fact, if you're a pro sports fan, you'll probably have heard the term advanced analytics, where they analyze the performance of the individual athletes. A smart investor will try to do the same thing with your startup using some type of analytics. Okay. We have another class that is partially built, which is startup traction metrics. So yes, there are some standard numbers. However, those numbers are going to change from startup to startup. How do you know what numbers to pay attention to? It comes down to your revenue model. Okay, so in the startup pitch coaching videos on YouTube, the fourth video, which we just released yesterday, okay, talks about traction metrics and what types of metrics to focus on. I encourage you to watch that video. Derek, if you could pop a link to maybe the playlist for the startup pitch coaching. It's the fourth video, the most recent one. We've got video number 5 coming out next week. It dives deeper into the traction metrics. That's the one. YouTube video number 5 for our startup pitch coaching will actually go into the revenue models. There are 10 different common startup revenue models. Each one of the 10 have different sets of metrics. So because every startup is different, what you need to do is identify which revenue model or models applies to you, then work with someone who knows and understands what investors will care about tied to that revenue model. Okay. So I could give a simple answer like CAC, customer acquisition cost, long-term value, or break-even time, all these things. Of course, those are things that apply to just about every startup, but some startups, customer acquisition cost is not a major concern. If you're a hard tech company, let's say you're building some type of rocket to fly, to bring a newfangled rocket to take satellites into orbit. How many customers do you have? You could be years in and still have 0 customers. Okay. So, some metrics don't matter or don't apply as much depending on what type of startup you are at. Okay.
Awesome. Let's go through. We had a question from Rodrigo who asked, have you heard of venture revenue-based financing?
Yes.
So do you have any inputs on it?
Yeah. So basically there's certain funders out there that will give you what they claim to be non-dilutive capital. And that's something that is very, very attractive. If you have revenue for your company, then you might be able to go to one of these lenders and show them your revenue, and they might loan you money. Okay. And then the contract that you sign is that you slowly pay them back over whatever period of time. The challenge is that, one, you have to be revenue cash flow positive, not just have revenue. You have to actually be demonstrating a profit. Okay. So how many startups early stage are profitable? Not very many. Okay. But if you are profitable, it could be a viable option for you. The other thing that these guys will typically do is that they probably want to see recurring revenue, not just the fact that you had lots of, 1,000 one-time deals. Okay. That it's hard to predict what the revenue will be in the future. So if you happen to have a recurring revenue model and you have $1 million in annual recurring revenue, then probably going to these revenue-based lenders or financiers could be an option.
Awesome. We had another question way back from Mary, who asked, she heard that investors generally don't like safes. How can she help investors overcome that objection? Or how can she,
Yeah. It is generally true, especially historically, that investors don't like safes. I don't invest very often, but when I do, I will always ask for a convertible note. You have to convince me to accept a safe, because a safe is more founder friendly generally. Okay. But the trend is going against that. If you watch the Safe Founder's Guide to Safe Fundraising, the other class that I mentioned, which is probably my second most popular class, you'll see that actual metrics from Carta show that now safes are twice as popular as convertible notes. That's probably more true in the Silicon Valley, because what the other thing that is found is that safes, since there's such a large concentration of startups in the Silicon Valley, a lot of investors have heard of safes. Once you start getting beyond the Silicon Valley, it's not as common. Okay. But it's starting to get more common. So yes, the statement that investors don't like safes or they're not comfortable with them, that's probably still true, but the trend is shifting away where safes are getting more popular. The one way that safes actually are more investor friendly is if they use a post-money safe. If an investor knows what they're doing and isn't able to get a convertible note, my fallback ask is I will want a post-money safe, not the pre-money version. Every safe today from the Y Combinator website, Y Combinator created the safe. If you look and download the safe today, it is a post-money safe, but post-money safes increase founder dilution. Okay. In the full 1 hour deep dive class, I show how it increases dilution and how you can minimize how much dilution is increased, how much dilution you take if your investor insists on a post-money safe. In general, if I was a founder, I would lead with, I want a pre-money safe, because that's the most founder friendly of the convertible instruments. Okay. But if in order to convince an investor that to take what you prefer, you have to build a fundable company. You can't just say, I demand, I insist, I want this. Well, if you're not very attractive, there's not a lot of investors who want to invest in you. You're probably not going to get what you want.
Awesome. We had John who asked if there's different strategies or thought process behind pursuing government grants.
Yes, yeah, there is. Our funding strategy class actually covers grants briefly, and then we have a deep dive class with a grant specialist. Okay, the deep dive class basically gets into what types of grants are there, when are they right for you? At a high level, government grants, great way if the grant aligns with what you're going to do anyway. If your startup is doing some type of research, et cetera, and it happens to be that the product, when it's built, could benefit one of the government agencies, and I'm speaking from a US perspective, you can probably extend this to your specific country. If the grant program aligns with what you're going to do anyway, then it might be an option. Okay. It takes a lot of time. It's like fundraising. It is a mistake to turn your startup in general. It's a mistake to turn your startup to try to get a grant, because oftentimes it'll be a distraction. Okay. But if it does align with what you're doing anyway, it can be a very good option. As I mentioned, we've got a little bit of content in the full funding strategy class. And then in the, let me back up here. Which version is it? In the pro tier, I believe, if you guys can see that, we've got a startup funding raising with grants class right there at the very center of the slide. Okay.
Oh, can you please explain what is it safe?
Oh, you missed it. Okay. It was explained in the beginning of this webinar. In a nutshell, it's a simple agreement for future equity. It's a funding vehicle that was created by Y Combinator to solve some of the problems of the convertible note. However, introducing a safe, when they created it, they introduced other problems that they did not realize. Okay, so that's all covered in my safe fundraising class. All right, it's an hour-long fundraising. We can point you to it. It's the replay is available in our basic training tier. Let me back up here. It's the class bottom center, the Founder's Guide to Safe Startup Fundraising. Hour long. The replay actually had so many questions. I think we went an hour and a half.
Thank you.
Yep. We had a question earlier from Sani, who asked, what's your advice if your startup is not based in the US, but want to raise through online accelerators, being able to pitch in the US?
Ooh, okay, so I guess it kind of depends. Oftentimes, if you're pitching to a US-based audience, they will want you to have a presence here. So they'll want you to form a Delaware C corporation. Do you have to 100% of the time? No, but most of the investors I've talked to, they prefer, the US-based investors will want you to do that. And if they don't have a overseas division, they'll want you to form and have a presence here and set up the domestic US company with the controlling rights for whatever it is. Because if it's just a sister company with no assets, with no control, why would they invest in the US-based company when, if the US-based company couldn't control the real company in whatever other country, they would never invest in the US company, because if the relationship fell apart, between the two companies, they would have invested in a corporate shell with nothing. Okay.
Got it. We had a question earlier from Martin, just asking to see if you could see the price comparison slide between us and the attorneys.
Oh, yeah. So it's this one here. The Silicon Valley partner rates are about 600 to 650. A mid-sized law firm, the partner doesn't do very many of the contracts. Okay, they hand it down to an associate or a senior associate who usually bills about 400 an hour, 400, 450 an hour. So you'll get a little bit of time from the partner, a lot of hours from the senior associate, but the senior associate doesn't really know strategy usually. They know the mechanics of the contract and they can operate under the direction of the partner. So it's really a two-person team. If you choose to, you can go to a small firm, but then it's hit and miss because they usually do not have as many of attorneys. The rates are going to be a little bit lower, but they usually don't have as many of attorneys with as much expertise. And you have to find a firm where the person, if it's a 3-attorney firm, you better make sure you get an attorney who truly knows the space. I've seen some smaller firms where they claim to do work with startups, but then when I start talking with the founder, there's all sorts of legal problems that can come up, from incorporation issues to foreign investment CFIUS issues. The attorney doesn't even know what CFIUS is. Okay, so yeah, that attorney at a small firm might have some startup experience, but they may not have enough to really do a good job. It takes honestly 10 to 15 years to develop the experience to know, oh, 5 years ago when that investor asked for this term, now I see when we're trying to get another round of investment or we're trying to sell the company, now I know why he asked for it. I thought it was simple. No, they don't teach that in law school. Okay, you need real world professional experience to get that. So sometimes the smaller firms, you really have to look hard to find a small firm that has good talent, who truly knows the space. Okay.
Awesome. We had a question that just came in from Steve, who asked if a startup is at an idea stage and he has investors willing to give him 200,000 just in reputation alone, how much of the company should he give away for this?
The answer is whatever the market will bear. Okay. The answer every founder wants to hear is sell as little of your company as possible when you're raising money. Generally, that's the answer that most people want to hear, but how much is as little as possible? Well, it depends on how popular your fundraise is. If you have, and literally this happened with other situations, the best way to get the best terms. Tim Harris, partner at Morrison Foerster, a fantastic legal attorney. He's a big law firm, so he's very, very seasoned, very expensive. Okay. But he's worth it, I think. Okay. If you can afford it. His comment was the number one way to get the best valuation is by building competition amongst investors. You build competition by building a attractive, fundable company. I'll be honest, I spend a lot of my time talking about fundraising. I don't want to. I would rather spend my time talking about execution so that you can build a fundable company. Fundraising, it's almost like going on a date and trying to learn a pickup line. And that's what a lot of people do when they're trying to teach people how to fundraise. You meet somebody you want to date and you say, hey, baby, what's your sign? I think that's just ridiculous. How to be able to say this, you get a good date by one, being a caring, considerate person, learning how to carry a conversation, being selfless, having a good job, bathing, brushing your teeth, simple things like that. You want to make yourself dateable, not learn the coolest way to, show off your big muscles. Be dateable, all right? Be fundable. And I think that's so much more important than the details of how to pitch. Of course, You don't want to pitch the wrong way. It's super important. But you can have a great pitch with a lousy startup, and you'll probably still have a very hard time raising money that you want to take at the valuations and terms you want.
Great answer. I think that's most of the questions I've seen. If I didn't get to your question, just put it back in the chat, or you can unmute. We'll be as long as people have questions.
I do have a hard stop at about 25 after, so I can go another 10 minutes if somebody wants to just. Okay. Thanks everybody for spending your time here. You are able to unmute and just ask a question live if you prefer. Okay. Hopefully this has been helpful. All right. Oh, and we do have other training classes that we'll do from time to time. We'll start scheduling more of these sessions on various other topics, hopefully to demonstrate to people, hey, we've got some good content and hopefully you can invest it. We can win your trust that the content will help you as a founder. Okay. All right.
We had a question about the recording.
Yeah, so our plan right now is to put this class up on YouTube. So you've registered. I think we'll get everybody's email. In a couple of days, we'll probably shoot out an email with a link to the YouTube recording. We thought about putting this into our basic training tier, but we just thought, I think right now we'll just put it up on YouTube. Okay. All right.
Awesome. We had a question just come in from Steve. He said, is it a good idea to reach out to VC firms 6 to 9 months before starting a funding round?
As a general rule of thumb, that's probably a good idea. It can be, anywhere from, your fundraising can take anywhere from 3 months to 12 months. I've heard stories of some companies that raised money in as little as 6 weeks, from start to finish. That's very rare, but the amount of time completely depends on how fundable you are. Okay. Some of it, if you happen to be a startup celebrity, okay, you had a big fat exit, one big fat exit, and you made some VCs rich, you could probably just name drop. Hey, I'm a celebrity. This was the company that I don't even have to introduce myself. I'm starting another company. Will you invest? You'll probably get money just because of your name alone. All right. Most people aren't big fat celebrities. I never was with the 5 startups. I'll be honest, my biggest exit was only 125 million. Okay. That's, nice, but it wasn't one of those blockbuster exits, 2, 3, 4 billion. Okay. All right.
We had a question come in from Harrison who asked, how long have you been doing this?
Doing startups in general, probably 22 years and 10 years of industry before that, management consulting and whatever else, all that stuff. But doing what I'm doing now with Fundable Startups, probably about 3 years. The first year and a half, I spent doing hands-on work with a lot of startups. I had my golden handcuffs fell off when Cisco acquired startup number 5. My golden handcuffs fell off. I wanted to go back to a small startup environment, and I just, started doing work with people I enjoyed working with. After a year and a half of work, lots of hard work, and a lot of worthless stock, I realized I need to be more discerning about who I work with. So the past 18 months of the last 3 years, I've been really focused on building training, because what ended up happening was that all the startups I did, the fractional CTO or the fractional CEO, whatever I did, I'd spend 20 hours a week with these companies, and I'd answer the same questions over and over again. I'd have to teach them the same things over and over again. And I wanted them to do as much of the work as possible, because it doesn't help them grow if I do it all for them. I'm happy to do some of the work because sometimes it's just faster. All right. Or if you don't have time, I'm happy to do it. But then it just costs more of my time, which means that the founder has to, somehow either have stock or cash to pay for my services. I'm trying to see what I can do to minimize the drain on your resources as a founder while still providing valuable help. Okay.
Awesome. We had a question coming from Dimitri who asked, do you have videos on different pre-seed funding options?
So I do have content. This class itself goes through some details about what is the common choices. We cover that some of that in the safe fundraising class as well as some stats. So the answer is yes. We do not have a dedicated class just on pre-seed fundraising because pre-seed fundraising means lots of different things with lots of different instruments. What I can do is just at least say that pre-seed usually means, if it's pre-seed, it's usually less than 500,000. Investments that are less than 500,000, if they're done right, they're almost always convertible notes or safes. You're not going to get a preferred stock sale from a professional investor for pre-seed because it's a lot of work, due diligence, legal work, legal costs to do a preferred stock sale. It's the same amount of overhead to do a $2 million investment than it is to do a $10 million preferred stock sale for the investor. Okay. They're not going to spend that amount of time to invest all that time, money, legal fees on a $500,000. Pretty much on a VC, they'll only do it for 2 million and up. Okay. So that means the pre-seed stuff, which is a lot smaller than 2 million usually, you're down to the convertible note and safe territory. Safes are, as I said earlier, are now 2 times more popular according to actual data from Carta. Okay. It used to be convertible notes were more popular 5 years ago. Now it's flipped. It used to be 2-to-1 convertible notes to safes. Now, as of 2021, it's now 2-to-1 safes to convertible notes. Safes do have smaller average amounts. So they're closer to 15 to 30,000. Once you get into the larger dollar amounts of investment from a single investor, they'll probably start asking for a convertible note. Okay. You might be able to convince them to use a safe. But again, I don't invest very often. My first ask is always a convertible note if I'm going to try to invest in a company.
We had a question from Steve come in asking, are VCs turned off by a founder who's both the CEO and the CTO?
Yeah.
In other words, do they prefer startups to have different roles in executive positions?
So early stage in the company, it's very much it's very much about the team. In fact, let me pull up a specific slide. It's a little bit more nuanced. I could say, yes, they're turned off, or no, they're not. I think it's a little bit more nuanced than that. Let me pop up. There it is. Okay, can you see this?
Yep.
All right. So Andrew Chen is a very respected partner at Andreessen Horowitz. Andreessen's commonly thought of, most people would say, name your top 5 VCs. Most of them will include Andreessen Horowitz as in that list. He made a very good comment earlier that basically, depending on what round you're in, these are the people that this is what you're betting on as an investor. Pre-seed, it's a very small team. You're probably betting on the lead entrepreneur. Seed, you're betting on the team, et cetera, and then traction, revenue, and unit economics. Okay. So to answer your question in a more nuanced way, is that VCs turned off by the one, I think the answer by one person being both CEO, CTO. I think VCs are turned off by founders who aren't, easy to work with. All right. I don't think they're turned off by having both roles in one person. I do think that as you get bigger, they're going to want to see the team. And if you're the CEO, the CTO, the CFO, the janitor, and you do everything, you don't have a very strong team. Okay. So think about where you're at, the earlier stages you're at, you can it might even be a plus to have one person be both, because it's nice to be able to have things can move faster, but eventually you will have to build a team around you. Like I said, I think most investors are turned off by founders who are hard to work with. Okay. This was another slide from my funding strategy class. So we get into lots of detail in it. Obviously, 4 hours of me talking, there's a lot to say.
So that's about it as we're wrapping it up. But hope you found this valuable. Sam, if you had any other words.
No, thank you for your investment in time. Sorry this went over, but we do, just to help us to be able to produce more content and stuff, please do consider some of our training content. It helps us to be able to fund this. And we'd love to be able to see you guys succeed and help you build your own very fundable company. Okay. All right. So got to wrap up. Thanks, everybody. We'll shoot out emails with the details on where you can get some of the recording for this session, as well as other resources available to you. Thanks a lot. Good luck.
Yeah, thank you, Sam.
If this was helpful, please like this video, subscribe to our channel, and click the bell to be notified when we release new content. When you do this, YouTube promotes our videos to others, which allows us to spend less time on our marketing and more time creating startup content for you. We hope this video helps you build a very healthy, fundable startup.